Have you ever looked at the world of investing and wondered what truly sets people apart? Why do some individuals seem to effortlessly grow their wealth year after year, building lasting financial security, while others, perhaps just as smart, perhaps working just as hard, find themselves struggling, often losing what they've gained? It's a question many people ask. You might be asking it right now. The answer might surprise you. It's not about having a genius-level IQ. It's not about getting lucky with some hot stock tip whispered at a party. Those things can give a temporary boost, sure, but they are not the foundations of sustainable long-term wealth. The real difference lies in something much more profound, yet accessible to everyone. Many believe that the secret to investment success is hidden behind complex formulas, or that it's only available to those with insider knowledge of Wall Street. This simply isn't true. Stop believing that right now. The path to becoming a successful investor isn't paved with secrets. It's paved with principles. It's about understanding the game, not just playing it. It's about approach, mindset, and a solid framework for making decisions. Too many people jump into investing with hope as their only strategy. Hope is not a strategy, people. You need more than that. You need a plan, a clear understanding of what you are doing and why. So, what is this powerful differentiator we are talking about? It boils down to a few key qualities you can cultivate. These are not traits you are born with, they are skills you can learn and master. Think about it. If it were just about luck, investing would be no different than gambling. And if it were just about raw intelligence, then only academics would be rich. But we know that's not the case, don't we? We see everyday people building extraordinary wealth through smart, consistent choices. They follow a philosophy, a time-tested approach that guides them. They avoid the common pitfalls that trap so many others. This crucial understanding is what we are going to explore together. We will uncover the timeless lessons that have guided the most successful investors. These are not fleeting trends or complicated schemes that promise instant riches. Instead, we are talking about a sound, sensible path to building real financial security. A path that empowers you to take control of your financial future. A path that helps you sleep at night, knowing your money is working intelligently for you. It's time to stop guessing and start investing with true confidence. Are you ready to learn the difference that makes all the difference? Then let's get started on this journey. The first cornerstone of building true, lasting wealth is discipline. What does discipline in investing really mean? It means having a plan and sticking to it. It means not getting swayed by the noise of the market, the daily headlines. It means resisting the urge to chase after every next big thing. So many people lose money because they react emotionally. They buy high out of excitement. They sell low out of fear. That is not a winning formula. Discipline is your shield against these costly emotional reactions. It's about making rational decisions based on sound principles, not fleeting feelings. It's about saying no to impulsive moves, even when everyone else is saying yes. This kind of control is absolutely essential for your financial well-being. The second cornerstone, equally important, is patience. Oh, patience is a virtue, especially in investing. Building significant wealth rarely happens overnight. It's a marathon, not a sprint. The market will have its ups and it will certainly have its downs. That's normal. Impatient investors get shaken out during those downturns. They panic, they sell. But patient investors understand that time is one of their greatest allies. They allow the power of compounding to work its magic over the long term. They don't obsess over short-term fluctuations if the long-term picture is sound. They understand that true value often takes time to be recognized by the market. Think of it like planting a tree. You don't dig it up every week to see if the roots are growing. You trust the process. Now imagine combining these two powerhouses, discipline and patience. When you have discipline, you create a solid investment strategy. You define your rules. When you add patience, you give that strategy the time it needs to bear fruit. This combination helps you avoid the most common investing mistakes. You won't be tempted to constantly tinker with your portfolio based on fear or greed. You won't abandon a sound long-term plan because of a temporary market hiccup. Instead, you stay the course, focused on your ultimate financial goals. This steady approach is what separates the consistently successful from the often disappointed. It's about playing the long game with unwavering commitment to your principles. These qualities, discipline and patience, are not just nice ideas. They are actionable. They are the bedrock upon which you can build a secure financial future. Without them, even the most brilliant investment insights can fall apart. Think of them as your internal compass, always pointing you towards sensible decisions. They keep you grounded when the market gets turbulent. They keep you focused when distractions try to pull you off course. Mastering these qualities is within your reach. It takes commitment, yes, but the rewards, financial peace of mind, and steady wealth growth are immeasurable. You have the power to cultivate these essential traits starting today. So, where can you find the wisdom to cultivate this discipline and patience? Where can you learn the principles that guide truly successful investors? The answer lies in a book, a timeless masterpiece that has shaped generations of investors. This book is The Intelligent Investor, written by the legendary Benjamin Graham. It's not just another finance book, it's often called the Bible of value investing. Think of it as your personal mentor, guiding you through the complexities of the market. It provides a clear, understandable, and proven framework for making smart investment choices. It's a book that doesn't just tell you to do, but to think like an investor. This is the knowledge that can truly transform your financial life. Benjamin Graham wasn't just an author, he was a highly successful investor himself. He was also a renowned professor, and his most famous student was none other than Warren Buffett. Yes, Warren Buffett, one of the wealthiest and most respected investors in the world. Buffett himself has said that The Intelligent Investor is by far the best book on investing ever written. That's a powerful endorsement, isn't it? Graham's teachings are not theoretical. They are practical, tested in the real world, and proven to deliver results over decades. He laid the foundation for what we now call value investing. This approach focuses on identifying the true, underlying worth of a company. It's about buying good businesses at sensible prices. Now let me be very clear. This book is not a get-rich-quick scheme. If you're looking for hot tips to double your money by next Tuesday, this isn't it. The Intelligent Investor is about building sustainable, long-term wealth. It's about preserving your hard-earned capital and making it grow steadily over time. It teaches you how to manage risk effectively, a crucial skill many overlook. It helps you avoid the speculative frenzy that can lead to devastating losses. Graham's philosophy is grounded in prudence, analysis, and a deep understanding of market behavior. It's about being intelligent with your money, not just lucky or reckless. This book, The Intelligent Investor, serves as your blueprint for financial freedom. It provides the intellectual toolkit you need to navigate the investment world confidently. It will teach you how to think for yourself, to analyze opportunities critically. It will empower you to make decisions based on reason and evidence, not emotion or hype. Reading and understanding its principles is like getting a masterclass from the father of value investing himself. It's your guide to becoming a truly intelligent investor, capable of achieving your financial goals. This is your opportunity to learn from the best, to build a foundation for a secure and prosperous future. Are you ready to discover the intelligent way to invest? It all starts here. When we talk about smart investing, one name stands above many others. That name is Benjamin Graham. He wasn't just another investor on Wall Street. No, Graham was a true pioneer, a deep thinker, a revolutionary in his field. He is widely and rightly known as the father of value investing. This title isn't just a fancy label, it signifies his monumental contribution. He literally wrote the book, several in fact, on how to invest wisely. His ideas changed how people approach the stock market, shifting focus from speculation to genuine investment. Understanding Graham is the first step to understanding how to build real, sustainable wealth. He provided a clear path for those who wanted to be intelligent about their money. Graham's wisdom wasn't just academic, it was forged in the fires of real-world experience. He lived through times of incredible financial upheaval, including the lead-up to the Great Depression. He saw firsthand how fortunes could be made and lost in the blink of an eye. These experiences deeply shaped his investment philosophy, teaching him the paramount importance of caution. He learned that protecting your capital was just as important, if not more so, than growing it. This wasn't about being timid, it was about being smart, about understanding risk. His approach was born from a desire to create a safer, more rational way to invest. He sought to replace the casino mentality with one of careful, reasoned analysis. This made his teachings incredibly practical and grounded in reality. Benjamin Graham wore two very important hats, and he wore them exceptionally well. On one hand, he was a highly successful investment manager, putting his theories into profitable practice. He didn't just talk the talk, He walked the walk, managing money for himself and his clients. On the other hand, he was a revered professor at Columbia Business School. It was here that he meticulously documented his investment framework, sharing his insights with generations of students. His seminal works, Security Analysis, and The Intelligent Investor, became instant classics. These weren't just textbooks, they were manifestos for a new, more intelligent way of investing. They laid out clear principles for anyone to understand and apply. So why, you might ask, are we still talking about a man whose major works were written decades ago? It's because Benjamin Graham's principles are timeless. They are as relevant today as they were then. In a financial world that's constantly buzzing with new trends, fads, and so-called innovations, Graham's wisdom is an anchor. It provides a solid foundation that doesn't crumble with the changing tides of market sentiment. His teachings cut through the noise, offering clarity and a sensible path forward. They remind us that true investing isn't about chasing quick profits, it's about sound judgment. For anyone serious about their financial future, Graham's lessons are not just old ideas, they are enduring truths. He gave us the tools to be truly intelligent investors. Section 2, The Intelligent Investor's Creed, Graham's Core Philosophy. So, what exactly is this value investing that Benjamin Graham championed? At its heart, it's a beautifully simple yet profound idea. It's about understanding that when you buy a stock, you are buying a piece of an actual business. You are not just trading a piece of paper or a blip on a computer screen. Therefore, your focus should be on the underlying value of that business, its health, its earnings, its prospects. This is a radical departure from merely chasing stock prices up and down. Graham urged investors to think like business owners, not like speculators. This fundamental shift in perspective is the first key to his philosophy. He wanted you to analyze the company, not just the chart. One of Graham's most liberating ideas was that you do not need to predict the future. Think about that for a moment. How much stress comes from trying to guess what the market will do next? Graham said, stop trying, it's largely a waste of your precious time and energy. The future is, by its very nature, uncertain and unpredictable for everyone. Instead, he taught that you should focus your efforts on making rational, well-researched decisions in the present. Base your actions on facts, on analysis, on the information you can actually know today. Your advantage comes not from a crystal ball, but from your discipline and your diligence. This approach empowers you to act confidently, regardless of market forecasts. The absolute cornerstone of Graham's philosophy is the concept of intrinsic value. Intrinsic value is what a company is truly worth, based on a thorough analysis of its assets, earnings power, and future potential. This is often very different from its current stock price, which can swing wildly based on market mood. The intelligent investor, Graham taught, looks for a significant gap between that intrinsic value and the market price. You want to buy $1 worth of assets for 50 cents, so to speak. This doesn't mean finding cheap stocks of bad companies. It means finding good companies at great prices. Calculating intrinsic value isn't an exact science, it requires careful judgment and honest assessment, but the pursuit of it keeps you grounded in reality. This entire approach, focusing on business ownership, present analysis, and intrinsic value, leads to one critical outcome: capital preservation. Graham's primary concern was not hitting home runs, it was avoiding strikeouts. He famously said, rule number 1, never lose money. Rule number 2, never forget rule number 1. By insisting on buying with a substantial discount to intrinsic value, what he called a margin of safety, you build in a cushion. This cushion protects you against errors in your own judgment or unexpected downturns in the business or market. It's a fundamentally conservative and risk-averse strategy designed for long-term survival and steady, sustainable wealth accumulation. It's about sleeping well at night, knowing your investments are soundly chosen. Section 3. A Legacy of Success. Graham's Influence on Investing Greats. Benjamin Graham's impact wasn't confined to the pages of his books. He was a teacher, a mentor, and his insights helped shape some of the greatest financial minds in history. His most famous student, as you might already know, is Warren Buffett. Yes, the Oracle of Omaha himself, one of the most successful investors the world has ever seen. Buffett consistently and publicly credits Graham as the guiding light of his investment philosophy. He often says that reading The Intelligent Investor early in his career was one of an important moment of his life. It wasn't just a set of techniques Buffett learned, it was a whole intellectual framework for thinking about investing. This powerful endorsement speaks volumes about Graham's lasting influence, but Warren Buffett wasn't the only one. Graham's teachings spawned a whole generation of highly successful investors. In a famous speech and article, Buffett highlighted a group he called the super investors of Graham and Doddsville. These were various fund managers who had all, in one way or another, been students or followers of Graham's principles. And what was remarkable, they all achieved consistently outstanding investment returns over long periods. Their diverse personalities and specific methods varied, but their core philosophy was pure Graham. This demonstrated that Graham's approach wasn't a fluke or dependent on one genius individual. It was a robust, replicable system for achieving superior results. The value investing philosophy, pioneered and codified by Benjamin Graham, has now become a globally recognized and deeply respected strategy. It's not some obscure niche approach, it's a mainstream pillar of modern finance. You'll find its principles taught in the business schools of top universities around the world. Countless successful professional investors and fund managers attribute their success to adhering to its tenets. It has proven its mettle through all kinds of market conditions, booms, busts, wars, and technological revolutions. The very fact that it has endured and thrived for so long is a testament to its fundamental soundness. It's a strategy built on logic and prudence, not on fleeting market sentiment. Perhaps the most empowering aspect of Benjamin Graham's legacy is its accessibility. He didn't write The Intelligent Investor for Wall Street insiders or PhDs in finance. He wrote it for ordinary people, for the average individual investor looking to manage their money wisely. His goal was to democratize the process of sound investing, to give everyone the tools they needed. You don't need a supercomputer or secret connections to apply his principles. What you need is a willingness to learn, the discipline to follow a rational framework, and patience. Graham believed that intelligent investing was within everyone's reach, and that, my friends, is a truly powerful message of financial empowerment. Section 1. The Defensive Investor, Prioritizing Safety and Simplicity. Benjamin Graham, in his profound understanding of human nature and markets, knew one crucial thing. He knew that not all investors are built the same. Your available time, your natural temperament, your willingness to truly dig into research, these things are vital. So, he wisely avoided a one-size-fits-all approach to investing. Instead, he outlined two primary paths for the intelligent investor. The very first step towards intelligent investing is to honestly figure out which path is yours. This self-knowledge is absolutely fundamental, people. It's the cornerstone of your entire financial journey. You must understand who you are as an investor. Let's first explore the defensive investor. Does this resonate with you? The defensive investor's main goals are clear and sensible. They seek, above all, the safety of their initial investment. They want to avoid costly errors. They also desire freedom from constant worry and the burden of making frequent complex decisions. You want your money to work for you, not make you a slave to the stock ticker, right? This investor prioritizes peace of mind above almost everything else. They are looking for a strategy that allows them to sleep soundly at night, secure in the knowledge that their capital is protected and working steadily. So, what does this mean in practical terms for the defensive investor? The strategy is all about simplicity and proven quality. Think about a straightforward, balanced portfolio. Graham often suggested a mix, perhaps an even split, between high-grade bonds and a diversified selection of leading common stocks. These are not speculative plays. These are shares in large, well-established, financially sound companies with a long history of profitability and consistent dividend payments. Alternatively, well-chosen mutual funds or exchange-traded funds, ETFs, can provide this diversification easily, spreading your risk. The key is minimal ongoing effort and decision-making after the initial setup. It's about keeping it simple and steady. What kind of results can the defensive investor realistically expect? It's important to have clear expectations from the outset. The defensive investor is not aiming to shoot the lights out or beat the market averages consistently. That's not the game they are playing, and that is perfectly fine. Instead, the goal is to achieve a reasonable, satisfactory return over the long haul. A return that preserves capital and allows for steady if unspectacular growth year after year. The real payoff here is not just financial, it's the priceless peace of mind that comes from a conservative, low-stress approach. You're building a secure future step by step with confidence. Section 2. The Enterprising Investor, the Path of Active Engagement. Now let's turn our attention to the other type of intelligent investor, the enterprising investor. This path is for those individuals who are able and genuinely willing to devote significant time and intellectual energy to managing their investments. If you have a keen interest in business analysis, if you enjoy research, and if you are prepared to do more than the average person, then this might be the path for you. The enterprising investor is not content with merely satisfactory returns, like those sought by the defensive investor. They are actively seeking to achieve results that are better than the market averages. They understand this requires more work, more skill, and a different mindset. What kind of activities does the enterprising investor undertake? This is where the real dedication shows, folks, so listen carefully. It's far more involved than the defensive approach of broad diversification and sitting tight. Enterprising investors engage in thorough, independent research. They delve deep into company financial statements, scrutinize business strategies, and assess the quality of management. They are often looking for undervalued securities situations where the market price of a stock is significantly below its true intrinsic worth. Some may even explore what Graham called special situations, like mergers or reorganizations, but these require highly specialized expertise and are not for the novice. This is not casual stock picking, it's a serious analytical endeavor. The commitment required for this enterprising path is substantial. Please hear me loud and clear on this because it is so important. This is not a casual pursuit you can dip in and out of and expect to excel or achieve superior results. It demands a significant investment of your personal time, a high degree of financial literacy and analytical skill, and robust emotional discipline. You must be capable of thinking for yourself, often against the prevailing market sentiment, which can be very difficult. You need the patience to see your well-researched investment theses play out, which can sometimes take a considerable amount of time, even years. This is a demanding role, make no mistake about it. So, what about the potential outcomes for the enterprising investor? If an investor possesses the necessary skill, the unwavering diligence, and the right temperament, the rewards can indeed be greater. They might achieve those superior returns they seek, outperforming the general market. However, and this is a crucial warning from Graham himself, the risks of underperformance are also very real. If you attempt this path without the requisite abilities or the genuine willingness to put in the hard work, you could end up with results far worse than a defensive investor. Many who try, Graham noted, fail to do better than the averages. So be brutally honest with yourself. Section 3. The Golden Rule. Know thyself and stick to your strategy. Now we come to a critical point, a golden rule if you will, that applies to everyone. Benjamin Graham emphasized that choosing between the defensive and enterprising approaches is a deeply personal decision. There is no right or wrong answer in an absolute sense. There's only what's right for you. What is right is what aligns with your individual capabilities, your available time, your financial knowledge, and your emotional makeup. The real danger, people, lies in a mismatch. It's when a person who is temperamentally suited to be a defensive investor tries to chase the higher returns of an enterprising strategy without putting in the necessary work or possessing the skill. That's a recipe for trouble, believe me. Once you have honestly assessed yourself and chosen your path, be it defensive or enterprising, the next crucial step is to stick with it. This is so important, I cannot stress it enough. You cannot be a defensive investor one week focusing on safety, and then, when the market gets exciting or a friend boasts of a big win, suddenly try to become an enterprising speculator the next. Consistency is key to long-term success. Market conditions will inevitably change, popular sentiment will undoubtedly swing, and new fads will constantly emerge. But your fundamental approach, your chosen discipline, should remain steadfast. Don't let short-term noise derail your well-thought-out long-term plan. Let's talk about emotions, those powerful forces of fear and greed that live inside all of us. These are the biggest enemies of any investor, whether you choose to be defensive or enterprising. If you let fear dictate your decisions during a market downturn, you might panic and sell at the worst possible time, locking in losses. If you let greed take over during a market boom, you might take on foolish risks, chasing unsustainable returns. Both the defensive and enterprising investor must constantly guard against these emotional pitfalls. Your chosen strategy, your clear rules, these are your best defense. They provide a rational framework to guide your actions. Ultimately, the core of intelligent investing, as taught so brilliantly by Benjamin Graham, lies in this profound self-awareness and unwavering discipline. It's not about having a crystal ball or finding some secret stock-picking formulas. It's about understanding yourself, your strengths, your limitations. It's about choosing an appropriate strategy that fits who you are, and then executing that strategy with diligence and patience through thick and thin. Whether you choose the path of the defensive investor, seeking safety and steady returns, or the path of the enterprising investor, aiming for superior results through hard work, success comes from staying true to your chosen course. That, my friends, is the intelligent way to build lasting wealth. Alright people, listen very closely now, because this concept is not just important, it is, according to Benjamin Graham himself, the absolute cornerstone of intelligent investing. If you grasp this one idea and truly take it to heart, you will be miles ahead of most investors out there. We are talking about the margin of safety. What is it? In the simplest terms, it means never paying full price for an investment. Never. It means demanding a discount, a significant one, between the price you pay for an asset and its actual underlying worth. This isn't just a suggestion, it's a fundamental requirement for protecting your hard-earned money. Think of it like this. You wouldn't go into a department store and happily pay the full suggested retail price if you knew you could get the same item for 30 or 40% off, would you? Of course not. You'd wait for a sale or you'd look for a coupon. The margin of safety in investing is that very same principle, applied to buying stocks or other assets. It's about finding a situation where the market is offering you a genuine bargain on a quality item. It's the difference between the true intrinsic value of a company and the price tag the market has slapped on it on any given day. This gap, this discount, this is your margin of safety. This isn't about being cheap or stingy. No. This is about being smart. It's about being prudent. It's about recognizing that the future is uncertain, and even the best analysis can sometimes be off the mark. The margin of safety is your built-in cushion against errors in judgment, against unforeseen negative developments in a business, or against the wild, unpredictable swings of the overall market. It's what protects your principal investment from significant loss. It's the financial equivalent of wearing a seatbelt and having airbags in your car. You hope you never need them, but you'd be foolish not to have them. Benjamin Graham insisted that this principle was the secret to successful investing, distilled down to 3 words: margin of safety. He believed it was the thread that separated genuine investment from outright speculation. Without it, you are essentially gambling that the price you paid is fair, or that it will only go up. That is a dangerous game, folks. A true intelligent investor doesn't play dangerous games with their money. They look for situations where the odds are firmly stacked in their favor, not by predicting the future, but by paying a price that already accounts for a good deal of potential bad news. This is foundational, people. Section 2. Your financial shock absorber. Why margin of safety is non-negotiable. Markets are unpredictable and often irrational. Even the soundest companies can see their stock prices dive due to market panic or bad news. If you paid full price, you're vulnerable. But with a margin of safety, downturns might only bring the price closer to what you paid. It protects you from your own errors in judgment. Even brilliant analysts can make mistakes. A large margin of safety provides a buffer. It's humility built into your process. Unforeseen events like economic recessions or technological disruptions can wreak havoc. Your margin of safety acts like a financial shock absorber. Ignoring this principle leaves you exposed. It's non-negotiable for smart investing. Section 3. Making margin of safety work for you. A practical approach. Start with doing your homework. Know the intrinsic value of an asset. Analyze the business earnings, assets, debts, future prospects, and management quality. Without an estimate of intrinsic value, the margin of safety is meaningless. Compare intrinsic value to the current market price. Ask, am I paying significantly less than what this is worth? If the market price is too close to your estimated value, wait. Don't chase stocks. Let opportunities come to you. Seek quality at a discount. The margin of safety provides protection, but the investment must have sound fundamentals. Consistently applying this principle reduces downside risk and increases potential returns. It brings peace of mind. This is how you build wealth intelligently and sustainably. Quality first, then look for the discount. Section 1. Your erratic business partner. Getting to know Mr. Market. Imagine you are in business with a partner named Mr. Market. He offers you different prices every day. Understanding his personality is key to investment success. He embodies the market's daily fluctuations and irrational behavior. Mr. Market is a manic depressive. Some days he's optimistic and offers high prices. Other days he's pessimistic and offers low prices. His mood swings are dramatic and often disconnected from reality. He offers to buy or sell shares at his quoted price. His quotes are just opinions, not true reflections of value. He serves you, not guides you. You are not obliged to transact with him. His opinion is just one data point. The intelligent investor uses Mr. Market's moods to their advantage. Never let Mr. Market influence your assessment of value. You are the boss of your investments. Ignore him when necessary. Use his emotional swings to your benefit. Maintain your independent judgment. Section 2. Decoding the daily drama, Mr. Market's moods as your opportunity. Mr. Market's offers are often irrational. His prices are driven by extreme emotions. When he's euphoric, he might overvalue your share. When he's depressed, he might undervalue it. The intelligent investor sees Mr. Market differently. When he's overly enthusiastic, consider selling. When he's overly pessimistic, consider buying. His mood is your signal for potential action. Most people mirror Mr. Market's emotions. They buy at the top and sell at the bottom. This is the opposite of what an intelligent investor does. Maintain emotional detachment from his highs and lows. Base decisions on your own analysis of value. Don't let Mr. Market's drama infect your thinking. Your independent judgment is your most powerful tool. Don't surrender it to him. He is a useful servant but a terrible master. Use his emotional swings to your benefit. Stay calm, rational, and in control. Section 3. The Intelligent Investor's Edge. Outsmarting Mr. Market, every time. Your fundamental strategy with Mr. Market is simple. On most days, do nothing. You are under no obligation to trade with him. Ignore him if his price doesn't offer a compelling opportunity. This freedom to ignore the market's noise is a huge advantage. Pay attention when his emotional state creates a clear opportunity. When he's pessimistic, offering a low price, consider buying. When he's euphoric, offering a high price, consider selling. Use his irrational despair or exuberance to your advantage. Your margin of safety protects you and enhances returns. The intelligent investor uses Mr. Market's swings to their benefit. Buy when he's fearful, sell when he's greedy. Ignore him when prices are neither a bargain nor extravagant. Your decisions are driven by your own analysis of value. This approach turns market madness into your advantage. Stay calm, rational, and in control of your financial destiny. Section 1. Defining the difference. Are you investing or gambling? Alright, let's get really clear on something absolutely fundamental. This is a distinction that Benjamin Graham hammered home, and it can make all the difference to your financial life. We need to talk about investing versus speculating. Now you might think, what's the big deal? Aren't they kind of the same thing? No, they are worlds apart, people. Understanding this difference is not just about words, it's about your entire approach, your expectations, and ultimately, your success or failure in building wealth. It is crucial. You absolutely must know which game you're playing. Are you truly investing your money, or are you just gambling with it? So, what does it mean to be an investor in Graham's world? An investment operation, as he defined it, is one which, upon thorough analysis, promises safety of principal and an adequate return. Did you hear that? 3 key parts: thorough analysis, safety of principal, and an adequate, not necessarily spectacular return. This means you do your homework. You dig deep. You understand what you are buying. You are not just throwing darts at a board. You are acting like a business owner, carefully considering the value and prospects of the company you are putting your hard-earned money into. It's a disciplined, reasoned process. It's about building, not just betting. Now, let's look at the other side of the coin speculation. What is that all about? Speculation is primarily concerned with trying to profit from market fluctuations. It's about predicting which way a stock price will move in the short term. Will it go up? Will it go down? The speculator is often less concerned with the underlying value of the business and more focused on stock charts, price momentum, or the latest hot tip. They are chasing quick gains, hoping to time the market perfectly. This often involves more risk, less detailed analysis of the actual business, and a much shorter time horizon. It's the thrill of the chase, the lure of a fast buck. Why is this distinction so incredibly important for you? Because if you think you are investing when you are actually speculating, you are setting yourself up for some serious disappointment and potentially big losses. You might be taking on far more risk than you realize. You might lack the proper strategy for what you are truly doing. The common mistake is to blur these lines, to call yourself an investor while behaving like a speculator. Graham wanted you to be honest with yourself. If you choose to speculate, fine, but acknowledge it for what it is. Don't confuse a gamble with a sound investment plan. Knowing the difference is the first step to financial clarity and control. Section 2. The Speculator's Peril: Chasing Shadows in the Market. Let's talk about the life of a speculator. It can be a real emotional roller coaster, can't it? When you're speculating, your mood can swing wildly with every tick of the stock market. One day you might feel like a genius because a stock you picked shot up. You're on top of the world. The next day, that same stock could plummet, and suddenly you feel like a fool, your stomach churning with anxiety. This constant up and down, the intense focus on short-term price movements can be incredibly stressful. It can consume your thoughts, affect your sleep, and even impact your relationships. Is that really how you want to live with your money? The allure of speculation is powerful, I get it. We all hear those stories, don't we? Stories of someone who made a fortune overnight on some hot stock. The media loves to highlight these tales of instant riches. It plays right into that very human desire to get wealthy quickly with minimal effort. It can seem so easy, so tempting. If they can do it, why can't I, you might think. But what you often don't hear about are the countless stories of people who lost their shirts trying to do the same thing. For every spectacular win you hear about, there are many, many more devastating losses that go unreported. Chasing these shadows is a dangerous game. The truth is, the odds are often stacked heavily against the pure speculator, especially in the long run. Trying to consistently predict short-term market movements is notoriously difficult, if not impossible, even for seasoned professionals. It's like trying to catch lightning in a bottle. Without a deep understanding of intrinsic value, without that crucial margin of safety we talked about, you are essentially betting on price action. It's very much like gambling in a casino. Sure, you might win a few rounds, you might get lucky, but over time, the house, in this case, the unpredictable nature of short-term market whims, usually has the edge. You are operating without a safety net. Now, Benjamin Graham wasn't entirely against all forms of speculation. He was a realist. He knew some people are drawn to it. His advice, however, was very clear and very firm on this. If you choose to speculate, you must do so with your eyes wide open. Understand that it's speculation, not investment. Crucially, he advised that you should only use a very small portion of your capital for such activities. Money you can truly afford to lose, your mad money, so to speak. And most importantly, you must keep your speculative activities strictly separate, both physically and mentally, from your serious investment operations. Don't let the speculative mindset contaminate your sound investment portfolio. Section 3. The Investor's Path: Building Wealth with Substance. So what does the path of the true investor look like? It starts with a completely different mindset, a more grounded perspective. When an intelligent investor buys a stock, they are not just buying a ticker symbol that wiggles on a screen, no. They understand that they are acquiring a part ownership in a real operating business. A business with employees, products or services, assets and earnings. This fundamental understanding changes everything. Your focus shifts from watching daily price blips to assessing the long-term health and value of the enterprise itself. You start thinking like a business partner, not like someone betting on a horse race. This thinking naturally leads to a different kind of activity, research, and analysis. Real investing requires due diligence. It means you roll up your sleeves and do the work. You study the company's financial statements, the balance sheet, the income statement, the cash flow statement. You try to understand its competitive position in its industry. You assess the quality and integrity of its management. You look at its history of profitability and its prospects for future growth. This isn't about finding a hot tip. It's about making an informed judgment about the underlying worth of the business. It's about substance, not just sentiment. What is the reward for taking this more deliberate analytical path? It's not the adrenaline rush of a quick speculative win. No, the investor's reward is something far more valuable and enduring. It is the steady, sustainable growth of your wealth over the long term. It's the peace of mind that comes from knowing your money is working intelligently for you, in sound businesses bought at sensible prices. It's about building real, tangible financial security brick by brick year after year. You're not just chasing paper profits that can vanish as quickly as they appear. You're building a solid foundation for your future. This is how true fortunes are made and kept. Ultimately, you have a clear choice to make. You can choose the frantic, often perilous path of the speculator, trying to outguess the market's every move, or you can choose the reasoned, disciplined path of the intelligent investor. As Graham taught, the intelligent path is to invest in businesses, not to gamble on stock symbols. It's about focusing on the real value, the underlying substance of the companies you partner with. This approach requires patience, it requires discipline, and it requires a commitment to thinking for yourself. But it is the path that leads to lasting financial well-being. Choose to be an owner, not a gambler. That is the intelligent decision. Section 1. The unhurried path to lasting wealth, embracing true patience. Alright, let's talk about something that trips up so many people. It's a virtue that feels almost old-fashioned in our fast-paced world. I am talking about patience, people. Real, deep, unwavering patience. Benjamin Graham knew, and he taught this so clearly, that genuine wealth, the kind that lasts, is almost never built in a hurry. It's not about that one lucky stock tip that makes you rich overnight. Forget that fantasy right now. That's not how intelligent investing works. Real financial success is a marathon, not a quick sprint to the finish line. Graham's most powerful advice, woven throughout The Intelligent Investor, is to embrace patience. It's the quiet force that underpins so much of your potential for long-term financial security. Now, why is being patient so incredibly difficult for so many investors? I'll tell you why. We are bombarded every single day with stories of instant success. The media loves to shout about the latest hot trend, the overnight millionaire. It creates this dangerous illusion that getting rich quick is not only possible, but normal. This makes the slow, steady path of patient investing seem boring, or even like you're missing out. Plus, the market itself is a constant source of noise and temptation, isn't it? Prices go up, prices go down, and the urge to react can be overwhelming. Resisting that urge, sticking to your plan, that takes real inner strength. Think of building wealth like filling a large jar with coins, one coin at a time. Each individual coin might not seem like much on its own, does it? But if you keep adding those coins consistently, day after day, week after week, that jar will eventually get full, and then it will overflow. That is the power of patient accumulation. It's about those small, steady efforts compounding over time into something truly substantial. Patience in investing isn't about just sitting on your hands and doing nothing. It's about having the discipline to stick to your sound investment plan, allowing your well-chosen assets the necessary time to grow and reflect their true value. It's a deliberate, active kind underscore of waiting. So this patience we're talking about is more than just passively waiting for time to pass. It's an active form of discipline. It's the strength to resist the siren song of market panic when prices are falling. It's the wisdom to avoid getting swept up in irrational exuberance when prices are soaring to unsustainable heights. When you've done your homework, when you've bought good businesses at sensible prices with a margin of safety, patience means trusting that analysis. It means giving your investments the breathing room they need to mature. Much like a farmer plants a seed and patiently waits for the harvest, trusting the process of growth. This is the bedrock of intelligent investing. Let's talk about one of the most magical forces available to you as an investor. It's a force that patient investors understand and harness. I'm talking about the power of compounding. You've probably heard of it, but do you really grasp its incredible potential? Albert Einstein supposedly called it the eighth wonder of the world. Simply put, compounding is when your investments generate earnings, and then those earnings generate their own earnings. It's like a snowball rolling downhill, getting bigger and bigger, gathering more snow as it goes. But here's the catch: the absolute key: compounding needs time. A long, uninterrupted runway of time to truly work its wonders and build substantial wealth for you. Patience provides that essential runway. Now, so many people get this wrong. They think the secret to investing is timing the market. They try to jump in right at the bottom just before prices shoot up. Then they try to jump out right at the top just before prices crash. Sounds great in theory, doesn't it? But let me tell you folks, it's nearly impossible to do consistently. Even the so-called experts get it wrong most of the time. Trying to time the market is often a fool's errand, leading to missed opportunities and costly mistakes. What Benjamin Graham and all truly wise investors emphasize is not timing the market, but time in the market. It's about being invested for the long haul. Think about planting a tree like that image we just saw. You plant a small sapling. You don't dig it up every week to check its progress, do you? You water it, you nurture it, and you give it time. Years pass, seasons change, and slowly but surely that sapling grows into a big, strong tree, maybe even one that bears fruit for you year after year. Your investments are very similar. When you invest consistently over time, through market ups and downs, you are giving your financial tree the chance to grow deep roots and strong branches. You stay the course. You don't get spooked by a little bad weather or try to uproot it every time you hear a new forecast. So here's your action point, your takeaway from this crucial lesson on patience. Invest consistently. Whether it's a small amount each month or larger sums when you have them, make it a regular habit. Don't try to jump in and out of the market based on fear or greed. Pick your strategy based on sound principles like those in The Intelligent Investor, and then stay the course. Let time and the power of compounding be your greatest allies. Patience isn't just a virtue in life. In the world of investing, it's a superpower. It's the key that unlocks the door to steady, sustainable, long-term financial freedom. Embrace it. Okay, let's get serious about protecting your hard-earned money. You've heard the old saying, haven't you? Don't put all your eggs in one basket. Well, when it comes to your investments, that saying is pure gold. It's gospel truth. Benjamin Graham, that wise teacher we've been learning from, knew this deep in his bones. He understood that even what looks like a sure thing can sometimes go sideways. No company, no matter how fantastic it seems today, is completely immune to trouble. No single investment is a guaranteed ticket to riches without any risk at all. Believing otherwise is just setting yourself up for a potential heartache, a big one. Prudence, remember that word? It's key here. Smart investors are prudent investors. Now you might be thinking, but Suze, what about those amazing rock-solid companies? The ones that have been around forever, the leaders in their field? Yes, even those great companies can stumble. It happens more often than you think. The world changes, doesn't it? New technologies come along and disrupt entire industries. Management can make mistakes even with the best intentions. Things go wrong. Unforeseen events like economic downturns or global crises can hit anyone. And sometimes the market just doesn't recognize a company's true value for a long time. Or it can fall out of love with a stock, even if the company is still doing okay. Risk, my friends, is an unavoidable part of investing. You can't eliminate it, but you can manage it. So what's the intelligent investor's defense against this unavoidable risk? It's a powerful strategy that Benjamin Graham championed: diversification. There's that "don't put all your eggs in one basket" idea again, and it's central. Diversification simply means spreading your investment money across different assets. Instead of betting your entire financial future on the success of one single stock or one industry, you divide it up. You buy a little bit of this, a little bit of that. The beauty of this approach is that if one of your investments takes a hit, it doesn't wipe you out. Your other investments can help cushion the blow. Hopefully, while one goes down, others might be holding steady or even going up. Now let's be crystal clear about what diversification does and doesn't do. Its primary job is to reduce your overall risk. It's a safety net. It's not necessarily designed to shoot your returns into the stratosphere overnight. You might not get the biggest, fastest gains if one particular stock you didn't overinvest in soars, but, and this is a very big but, it significantly lowers your chances of a catastrophic loss. And that, people, is what intelligent long-term investing is all about: protecting your principal. Think of it as a key tool for the defensive investor we talked about earlier. It's about playing good defense, managing risk intelligently, so you can stay in the game. It helps you build wealth steadily and sustainably, without those terrifying plunges. This thoughtful approach is how you secure your financial future with wisdom. Okay, so you understand why diversification is so incredibly important. That's fantastic. But the next big question is, how do you actually do it? How do you build that financial fortress? It's not just about going out and buying, say, 20 different technology stocks. No, that might feel like you're diversified, but you could still be very exposed. If the whole tech sector takes a dive, all your different stocks could go down together. True diversification is more thoughtful, more strategic than just owning many things. It's about spreading your money across different kinds of investments, different categories that tend to behave differently in various market conditions. This is how you build real resilience into your portfolio, protecting what you've built. The first layer of smart diversification is spreading your money across different asset classes. What are asset classes? Think of them as big buckets for your investments. The main ones you hear about are stocks, also known as equities. These are shares in companies. Then there are bonds, which are essentially loans you make to governments or corporations. Stocks offer higher growth potential but usually come with more risk and volatility. Bonds, on the other hand, are generally considered safer, offering lower but more stable returns. Sometimes, when stocks are doing poorly, bonds might be doing okay, or even well. And some people also consider things like real estate as another asset class to diversify into. The key is that these different classes often don't move in perfect lockstep with each other. Once you've spread your money across different asset classes, you need to diversify within them too. Let's take stocks, for example. Don't just buy stocks in one single industry. If all your stocks are in, say, oil and gas, and that sector hits a rough patch, you're in trouble. Instead, spread your stock investments across various sectors: technology, healthcare, consumer goods, financials, and so on. Also, think about diversifying by company size. Some large established companies, large cap, some medium-sized ones, mid cap, and maybe even a few smaller growing companies, small cap. And don't forget geography. Consider both domestic and international stocks for broader reach. The goal is to avoid having too many eggs in any one industry or any one type of company. Even if a particular sector is currently booming, don't go all in. That's not smart investing. What Benjamin Graham really emphasized was building a balanced portfolio. This balance comes from sensible diversification across different industries and asset classes. Your action point here is clear. Construct your portfolio thoughtfully. Do not just wing it. And once you have that diversified plan, stick to it. Keep your emotions out of it. Diversification actually helps you do that. It helps you remain disciplined. When one part of your portfolio is down, you won't feel that same urge to panic, because you'll know that other parts are likely performing differently, cushioning the impact. This isn't just about numbers, it's about your peace of mind, your ability to sleep at night. It's about creating long-term stability so your wealth can grow steadily, securely for years to come. Alright, let's talk about a really important balancing act in your investment life. It's something Benjamin Graham believed was crucial for intelligent investors. We're talking about how you mix stocks and bonds in your portfolio. Now you might be tempted to go all in on stocks, chasing those big growth numbers, or maybe you're thinking of hiding all your money in super safe bonds. But hold on a minute. Graham taught that for most of us, the smartest path is a blend. It's like a financial seesaw. You need both sides to work together properly. This isn't just a casual suggestion, it's a core piece of building a resilient financial future. You need that combination of potential growth and reliable stability. So, why this need for a mix? Well, stocks and bonds play very different roles. Think of stocks, shares in companies as the engine of your portfolio. They have the potential to deliver higher returns over the long run, helping your money grow faster. But, and this is a big but, they also come with more bumps in the road. More risk, more volatility. Now think of bonds. These are like loans you make to governments or companies. Bonds are generally your portfolio's shock absorbers. They aim for capital preservation and steady income. They usually offer lower returns than stocks, but they also tend to be much less volatile. Understanding these distinct personalities is absolutely key to smart asset allocation. Now imagine putting these two different players on the same team. That's where the magic happens. When the stock market is having a rough time, when those growth engines are sputtering, what happens? Your bonds can act as a cushion, a stabilizer, helping to reduce the overall losses in your portfolio. They can provide a sense of calm when the stock market waters get choppy, believe me. Conversely, when bonds are offering very modest returns, your stocks are there working to boost your overall growth. This combination helps to smooth out the investment ride for you. It's not just about how one stock or one bond does, it's about how your entire portfolio behaves. This balanced approach can help you sleep better at night, knowing you're not overly exposed. Benjamin Graham often suggested a starting point, especially for the defensive investor. He talked about perhaps a 50-50 split between stocks and bonds, 50% in stocks, 50% in bonds. This provides a very straightforward and sensible balance for many people. But listen, this isn't a rigid set-in-stone rule that you can never ever change. No. The key idea is the principle of having a considered allocation between these two major asset classes. It's about deliberately choosing a mix rather than just letting your portfolio be 100% in one thing by default. This thoughtful combination is a true hallmark of an intelligent, prudent investor. It's about building a solid foundation for whatever the market throws your way. So, we've established that this stock and bond mix is super important, good. But here's the next step. That mix doesn't have to stay exactly the same forever. In fact, Benjamin Graham taught that intelligent investors should adjust their allocation. They should make changes based on careful thought and changing circumstances. One of the biggest factors influencing these adjustments is the state of the market itself. For instance, what if stocks start to look wildly overpriced, really expensive compared to their real value? Graham suggested that in such times you might want to reduce your stock holdings. You'd shift some money from those pricey stocks over to the relative safety of bonds. Conversely, if stocks look incredibly cheap, that might be a time to increase your stock allocation. Another huge factor in finding your personal equilibrium is your own risk tolerance. What is risk tolerance? It's your ability to stomach those inevitable ups and downs in the market. Can you sleep peacefully at night if your portfolio drops 10% or 20%? Or does that send you into a panic? Your age also plays a role here. Younger folks with a longer time horizon can often afford to take more risk. Older investors, closer to retirement, typically want more stability and capital preservation. The defensive investor we talked about might stick closer to that 50-50 split. An enterprising investor might be willing to make more aggressive shifts in their allocation. Knowing yourself, your goals, and your comfort level with risk is absolutely vital here. Now, how do you actually make these adjustments? It's not about frantically trading every day. No, that's market timing, and we know that's usually a losing game. This is about thoughtful, periodic rebalancing back to your target or within certain ranges. Graham even suggested setting bands for your stock allocation, for example, never holding less than 25% in stocks and never more than 75%. The same would apply in reverse for bonds. This creates a disciplined framework. When market movements push your allocations outside these bands, you'd rebalance. You'd sell some of what has done well and buy more of what has lagged. This disciplined process keeps your portfolio aligned with your long-term strategy. The ultimate goal here, people, is to always maintain a solid balance, even as you make adjustments. You're not trying to make wild bets or completely abandon one asset class for another. The danger lies in overreacting to market noise and making extreme emotional shifts. So your action point is this: adjust your asset mix as market conditions and your personal situation change. But always do it with an eye towards maintaining that fundamental, reasoned balance. This isn't about trying to outsmart the market in the short term. It's about strategically managing your assets for long-term success, the intelligent way. This disciplined, balanced approach is what will help you reach your financial goals. Investing isn't a one-size-fits-all suit, people. You can't just copy what your brother-in-law is doing, no matter how smart he thinks he is. What sends him into joyful dances might give you sleepless nights, and that's perfectly okay. Benjamin Graham knew this. He understood that true intelligence in investing starts with understanding yourself first and foremost. It's about crafting a financial strategy that feels right for you, that aligns with your unique life and your unique feelings about money. There isn't one single correct portfolio out there for everyone. The only correct portfolio is the one that fits your personal circumstances and your emotional constitution. So, let's forget about keeping up with the Joneses and focus on what makes sense for your financial well-being. This self-awareness is not just a nice-to-have, it's an absolute must-have for long-term success and peace of mind. Several key ingredients go into cooking up your personal risk tolerance. First, let's talk about your financial goals. Are you saving for a down payment on a house in 2 years? That's a short-term goal, and it means you probably can't afford to take big risks with that specific pot of money. Or are you investing for retirement, which might be decades away? A longer time horizon can often allow for a bit more adventurousness in your investment choices, as you have more time to ride out any market bumps. Your age is a big factor here too. If you're young, you generally have more years to recover from any market downturns. If you're closer to needing that money for income, capital preservation becomes much more important, doesn't it? And then there's your overall financial situation, your income, your job security, your existing savings, and your debt load. All these practical elements shape your capacity to take financial risks. These aren't just numbers, they are critical pieces of your personal investment puzzle. Ignoring them is like trying to build a house without looking at the blueprints. Beyond the practical stuff, there's something even more personal. Your temperament, your emotional DNA, if you will, when it comes to money and uncertainty. How do you genuinely, deep down, feel when you see your investment values drop significantly? Do you see it as a terrifying disaster, a sign that you've made a huge mistake, and feel an overwhelming urge to sell everything immediately to stop the pain? Or can you look at a market dip with a calmer perspective, perhaps even seeing it as a potential buying opportunity if you trust your research and your long-term plan? Some people are natural-born worriers when it comes to their finances, while others are more laid back and can stomach more volatility. There's no shame in being cautious. In fact, it can be a real strength if you acknowledge it and build your plan accordingly. This emotional side of investing is incredibly powerful, and if you don't understand your own typical reactions, you're essentially flying blind in a storm. Being brutally honest about your emotional responses is absolutely crucial for making sound, sustainable decisions. So, why do we spend all this time talking about your goals, your age, your financial situation, and your temperament? Because it's the bedrock of your entire investment strategy. Understanding these elements before you even think about buying a single stock or bond is absolutely essential, people. It's like a doctor diagnosing your condition thoroughly before prescribing any medicine. You wouldn't want it any other way, would you? Your investment strategy needs to be tailored to you, fitting you as perfectly as your favorite pair of comfortable shoes, not like some ill-fitting garment you borrowed. If you try to force yourself into an investment approach that doesn't align with your true risk tolerance, you're just setting yourself up for a world of stress and anxiety. You'll be constantly second-guessing yourself, making impulsive emotional decisions, and quite possibly losing money in the process. The goal is to create a plan that you can stick with, through thick and thin, precisely because it feels right for you and your life. That's the path to investing with genuine confidence and sleeping soundly every single night. Okay, so you've thought about your goals, your age, your general personality, and your financial capacity for risk. That's a great start, a really important first step. But understanding your risk tolerance isn't just a theoretical exercise you do once on paper, people. It's about how you, when things get real in the market. The stock market will have its challenging moments, trust me on this. There will be days or even weeks and months when prices go down, sometimes quite sharply and unexpectedly. How do you truly feel in those intense moments? Forget what you should feel, or how brave you might want to appear to others. Are you glued to the financial news, your heart pounding in your chest, feeling sick to your stomach with worry? That's a clear signal your risk level might be too high for you. Or can you acknowledge the drop, review your long-term plan, and carry on with your day without undue anxiety consuming you? Some people see those downturns as a chance to buy good companies cheaper, while others just see a terrifying, irreversible loss. Your genuine gut reaction during market turbulence is a very powerful indicator of your true risk tolerance. This brings me to a very simple, yet incredibly powerful tool for checking if your investments truly match your personal comfort level. It's what I call the sleep at night test, and it's a concept Benjamin Graham himself valued, the paramount importance of maintaining your peace of mind. Ask yourself this honest question, and really ponder it. Can I sleep peacefully with my current investments? Are you tossing and turning at night, worried sick about what the market will do tomorrow morning? Are those scary financial headlines hijacking your thoughts and ruining your dinner conversations? If your investments are causing you persistent anxiety, if they are robbing you of your precious peace and quiet, then something is fundamentally wrong with your current setup. Your financial plan should be a source of security and growing confidence, not a source of constant stress and worry that diminishes your quality of life. No potential return, no matter how high it might seem, is worth sacrificing your mental and emotional well-being over. So, take a quiet moment, maybe even journal about it. How are your investments truly making you feel on a daily basis? What if you take this sleep at night test and the honest answer is, no Suze, I am definitely not sleeping well at all. My investments are stressing me out. First things first, don't beat yourself up about it. This isn't a failure, it's a valuable piece of information you've just uncovered about yourself and your current plan. The solution is straightforward. Though it might take some courage and decisiveness to implement, you need to reduce your risk until you find a level you can live with comfortably. This doesn't mean you're a bad investor or that you've failed. It means you're becoming a more self-aware investor by listening to your own internal signals. Reducing risk could mean shifting some of your money from potentially more volatile stocks to more stable bonds, like we discussed earlier. It could mean choosing investment funds that are known for lower volatility, even if their potential for sky-high growth is more modest. Or it might involve taking a good hard look at your overall financial plan with a trusted advisor and making thoughtful adjustments to better suit your true demonstrated comfort level. It is always okay to dial down the risk until you find that sweet spot where you feel secure and in control. Ultimately, knowing yourself, your real experienced risk tolerance, is the absolute foundation of intelligent investing. It's not just a chapter in a book you read once, it's an ongoing commitment to self-awareness and honest assessment. This understanding isn't something you figure out once perfectly and then forget about for the rest of your life. Life changes, doesn't it? Your financial goals might evolve as you get older, your family circumstances might shift, your income could change, and even your temperament or outlook can change as you gain more life and investment experience. So continue to check in with yourself regularly. Keep asking that crucial sleep at night question, especially during periods of market stress. The intelligent investor isn't trying to be the bravest person in the room, chasing the highest possible returns regardless of the personal cost in stress and anxiety. No, the truly intelligent investor is building a portfolio that allows them to achieve their financial goals while living a life free from constant money anxiety. Be honest with yourself, make adjustments when needed, and build a financial future that truly supports your peace of mind. That's how you master your money, and in doing so, help master your life. Alright people, gather round because we need to talk about one of the most important lessons Benjamin Graham ever taught us. If you get this one thing, you are on your way to becoming a truly intelligent investor. It's a simple phrase, but oh, it is so powerful. Price is what you pay, value is what you get. Now I want you to burn that into your brain. Most folks out there, they look at a stock price, that number flashing on their screen, and they think that's what the company is worth. Wrong, wrong, wrong. That ticker symbol is just a number, a fleeting opinion. It is not the whole truth, not by a long shot. Understanding this crucial difference, the gap between a temporary price tag and lasting real value, is an absolute game changer for your financial life, believe me. So why, you might ask, do stock prices often seem to have a mind of their own, totally disconnected from the actual, underlying value of a business? Well, let me tell you, it's largely thanks to our old friend Mr. Market with his wild emotional roller coaster. Remember him? One day he's euphoric, the next he's in despair. Stock prices get pushed around by so many things that have nothing to do with a company's long-term health. Daily news headlines, analyst upgrades or downgrades, general market panic, or even just plain old speculative frenzy. The price you see today might be sky high because of hype, or rock bottom because of irrational fear. It's often just a reflection of the crowd's current mood, and crowds, as we know, can be famously fickle, and often wrong. Don't let that daily dance of numbers fool you into thinking it represents true, enduring worth. If that daily stock price isn't the real measure, then what exactly this true value that Benjamin Graham was so focused on? Listen closely, because this is where the intelligence comes in. True value isn't found in the noise of the market. It's found deep inside the business itself. It's about the company's genuine ability to earn money, consistently and reliably, year after year. It's about the solid, tangible assets it owns, things like buildings, equipment, and valuable patents. It's reflected in the strength of its financial position, its manageable debt levels, and its realistic prospects for sustainable future growth and profitability. This, my friends, is the real substance, the bedrock of an investment, not the fleeting shadow cast by its ever-changing stock price. It's about what the business would be worth to a knowledgeable private buyer, and what happens if you ignore this fundamental value and only chase after those alluring, fluctuating prices. Oh, that is a dangerous game, people, a very dangerous game indeed. If you're only looking at the price tag, you are essentially flying blind, making decisions based on market sentiment rather than sound business judgment. You could easily end up paying a ridiculously high premium for a company that's all sizzle and no steak, just because its stock price is going up. That's how so many people get burned and lose their hard-earned savings. Buying a stock simply because it's popular or because everyone else is doing it is not investing. It's speculation. It's gambling with your financial future. Benjamin Graham taught us to be far smarter than that, to always demand real underlying value for every single dollar we invest. So, the big question is, how do you, as a newly minted intelligent investor, actually uncover this true value we've been talking about? Well, there's no magic wand, I'm afraid. It takes effort. You have to roll up your sleeves and do your homework. Benjamin Graham didn't offer shortcuts. He offered a sound, methodical approach. He taught us to look closely at a company's fundamentals. Now, fundamentals might sound like a fancy Wall Street term, but it's really just about examining the basic facts of a business. We're talking about carefully studying its earnings reports, understanding its dividend history, assessing its overall financial health and the assets it holds, and looking critically at its long-term growth potential. This, right here, is your essential toolkit for finding those investment diamonds hidden among the market's pebbles. Let's start with earnings, because earnings are truly the lifeblood of any successful business. You want to see a company that generates consistent, reliable profits, not just a flash in the pan. Are those profits growing steadily over time, or are they erratic and unpredictable? Does the company have a strong, proven track record of turning its operations into real spendable cash for its shareholders? You need to look for high-quality earnings, the kind that come from the core business operations, not from some one-off accounting trick or selling a big asset. Strong, sustainable earnings tell you a great deal about a company's operational efficiency, its management skill, and its ability to create ongoing future value. This is the engine that powers growth and can support those lovely dividend payments. Next up in your toolkit are dividends and assets. Now, dividends are actual cash payments that some companies make to you, their shareholders, right out of their profits. A company with a long, stable, and preferably growing dividend history is often a wonderful sign. It can indicate financial maturity, consistent profitability, and a management team that is disciplined and committed to returning value directly to its owners. It shows they're not just hoarding cash, they're sharing the success. And what about a company's assets? These are the tangible and intangible things the company owns, like its factories, its real estate, its inventory, its cash reserves, and even valuable intellectual property like patents and brands. Strong, valuable assets can provide a vital margin of safety, acting as a sort of floor under the company's intrinsic value, especially if times get tough. Finally, and this is so crucial, you must always examine a company's long-term growth prospects and its overall financial robustness. Is the company operating in an industry that has a bright, expanding future, or is it in a declining sector? Does it possess a strong, durable competitive advantage, something special that protects it from rivals? And please, pay very close attention to how much debt the company is carrying on its books. Excessive debt can be a real killer, even for an otherwise good business, especially when interest rates rise or a recession hits. So, your action point here is crystal clear, folks. Before you even about investing your precious money in any company, you must diligently study these fundamentals. Scrutinize the earnings, review the dividend history, assess the assets, understand the growth outlook, and check the debt levels. This thorough due diligence is not optional. It is absolutely essential for intelligent, long-term investing success. Alright, we have covered so much rich wisdom from Benjamin Graham's The Intelligent Investor, haven't we? We've explored the core principles, the timeless strategies, and the crucial mindsets you need to build lasting wealth. Now, it's time to bring it all together in a super practical way. Think of it like this: a pilot, no matter how experienced, always goes through a pre-flight checklist before taking off. Why? To ensure safety, to ensure every critical system is checked to avoid costly mistakes. Your financial journey deserves that same level of care and diligence. So let's create your very own Intelligent Investors Checklist, a powerful tool to guide every single one of your investment decisions from this day forward. This isn't just a summary, it's your action plan for success. First and foremost, at the very top of your checklist, shining like a beacon, is this golden rule: always, always buy with a margin of safety. We've talked about this, but it bears repeating endlessly because it is that important. This means you never ever pay full price for an investment if you can help it. You are looking for that beautiful gap between the market price and the company's true intrinsic value. That discount is your cushion, your protection against errors in your judgment, against unexpected bad news, or against Mr. Market's irrational mood swings. It's what allows you to invest with confidence, knowing you've built in a buffer. This isn't about being cheap, it's about being incredibly smart and prudent with your hard-earned money. Next on your checklist is a point of crucial self-reflection. Know whether you are a defensive or an enterprising investor. Remember this distinction? It's absolutely fundamental. Are you seeking, above all, safety of principle and freedom from constant effort? Then the defensive path, with its simpler strategies and focus on high-quality diversified holdings, is likely for you. Or are you genuinely able and willing to devote significant time, research, and skill to seek market-beating returns? Then the enterprising path might be your calling. The key is to be brutally honest with yourself about your temperament, your available time, and your financial knowledge. Once you choose, stick to that path with discipline. Don't try to be both, or switch based on fleeting emotions. The third vital item on your pre-investment checklist: treat stocks like business ownership, not like lottery tickets. This is a profound mindset shift that Graham championed. When you buy a share of stock, you are not just purchasing a piece of paper or a blinking symbol on a screen that you hope will go up. No, you are becoming a part owner of a real operating business, a business with employees, products, customers, assets, and earnings. This perspective forces you to think like a proprietor. You'll start asking the right questions. Is this a good business? Is it well managed? Does it have a strong future? This focus on the underlying enterprise will keep you grounded in reality, far away from the speculative frenzy of mere price chasing. Continuing with our essential checklist, the fourth principle you must never forget is to ignore Mr. Market's emotional mood swings. Oh, that manic-depressive partner of yours we talked about. Some days he's wildly optimistic, offering you sky-high prices. Other days he's utterly pessimistic, trying to sell you his shares for pennies on the dollar. The intelligent investor understands that Mr. Market is there to serve you, not to guide you. You use his irrational extremes to your advantage, buying when he's fearful and selling when he's greedy. But you never, ever let his daily drama dictate your own investment decisions or infect your own judgment about a company's true underlying value. Maintain your emotional cool always. Fifth on our list, and this is a big one, folks, avoid speculation. Focus squarely on value. We've clearly defined the difference between investing and speculating, haven't we? Investing is based on thorough research, careful analysis of a company's fundamentals, and a long-term perspective. It's about determining intrinsic value and buying with that crucial margin of safety. Speculation, on the other hand, is often just a guess, a bet on short-term price movements driven by hype or hope. While a quick speculative win might seem tempting, the losses can be swift and devastating. As an intelligent investor, your focus must remain steadfastly on identifying and acquiring genuine value, not chasing fleeting price trends or hot tips. This is how you build sustainable wealth. Now let's bring in two interconnected principles for our sixth and seventh checklist items: stay diversified and always be patient. And closely linked to this is the need to review your asset allocation regularly. Diversification, spreading your investments across different assets and industries, is your shield against catastrophic loss. It ensures that if one investment performs poorly, your entire portfolio isn't wiped out. Patience is your superpower, allowing the magic of compounding to work over time and letting your well-chosen investments mature. Then, regularly reviewing your asset allocation, that mix of stocks, bonds, and other assets, ensures your portfolio stays aligned with your goals and risk tolerance, especially as market conditions change. These are your long-term wealth-building disciplines. So, here's your final most important action point for this entire discussion. Print this checklist. Keep it visible. Follow it religiously before every single investment decision you make. Seriously, people, don't just nod your head and forget about it. Make it a physical part of your investment process. This checklist encapsulates the timeless wisdom of Benjamin Graham. It's your compass in the often confusing world of finance. It will help you stay disciplined, avoid emotional mistakes, and make rational choices. Following these principles won't guarantee you'll never make a mistake, but it will dramatically increase your odds of achieving long-term financial success, and just as importantly, genuine peace of mind. This is your blueprint. Use it wisely. Benjamin Graham, that wise teacher of investing, left us with a truly profound warning. He said it loud and clear, so listen up, people. The investor's chief problem, and even their very worst enemy, is likely to be themselves. Yes, you heard that right. It's not some complicated market force out to get you. It's not about needing a genius IQ to decipher Wall Street's secrets. The real battle, the one that truly matters for your money, is an internal one. It's fought every single day against your own human emotions. Your deep-seated fear, your sudden surges of greed, and those dangerous moments of overconfidence that can sneak up on anyone. These inner demons, folks, are the real threats to your long-term financial well-being. Now let's talk about these powerful emotions because they can cost you dearly. Think about fear. When the market takes a nosedive, what does fear scream at you to do? It screams, sell! Sell everything now before you lose it all. And so many people listen, panicking and selling at the very bottom, locking in terrible losses. Then there's greed, fear's equally dangerous twin. When a stock is soaring, when everyone is talking about getting rich quick, greed whispers in your ear. Buy more! Mortgage the house! This is it! It pushes you to chase bubbles. It tempts you to take on far too much risk, throwing caution to the wind. This emotional roller coaster is no way to build lasting wealth, believe me. Then we have overconfidence, that sneaky saboteur of so many investment plans. Maybe you've had a few successes, a few good stock picks. It's easy to start thinking you've got the Midas touch, isn't it? You start believing you can outsmart the entire market, that you know better than anyone. This is when you might forget Benjamin Graham's most crucial lesson, the margin of safety. You start paying too much, taking on risks without that vital cushion. Humility, people, is a virtue in investing. Acknowledging you don't know everything is strength. It keeps you grounded and helps protect you from your own potential blind spots. This self-awareness is absolutely critical for smart decision-making. So, what's the big takeaway here? Mastering these internal battles is paramount. It is just as important, if not more so, than mastering all the financial formulas and analysis techniques. You can have the best research in the world, the most brilliant insights, but if you don't have the emotional discipline to act rationally, it can all fall apart. The intelligent investor isn't just about being smart with numbers, it's about cultivating an intelligent. A character built on discipline. A character built on patience, on prudence, and on unwavering self-awareness. This, my friends, is the true foundation of long-term investment success. It's about conquering yourself before you try to conquer the market. Benjamin Graham's masterpiece, The Intelligent Investor, doesn't offer you a crystal ball. It doesn't pretend to teach you how to predict the market's next big move. No, sir. Because trying to predict the future is a fool's game, and Graham knew that. Instead, his timeless wisdom is all about one thing, helping you for the future. An uncertain future, yes, but one you can navigate with skill and confidence. This preparation begins with profound self-awareness, understanding who you are. Knowing your personal risk tolerance, your financial goals, your true investor type. Are you defensive, seeking safety, or enterprising, ready for more research? This clarity is your starting point on the intelligent path. The principles we've explored together, drawn from Graham's enduring teachings, are your tools. These are the solid building blocks for your financial preparation, your fortress, always insisting on that vital margin of safety before you buy anything. Understanding and using Mr. Market's emotional swings to your advantage, not your detriment. The incredible power of diversification to protect your capital from unexpected shocks. The absolute necessity of patience, letting time and compounding work their slow magic. And of course, the commitment to thorough research, treating stocks as ownership in real businesses. These aren't just abstract concepts, they are actionable strategies for your success. They are your blueprint for making sound, reasoned investment choices. True, lasting financial success doesn't come from chasing those get-rich-quick schemes. It doesn't come from listening to hot tips whispered at a cocktail party. It doesn't come from trying to time the market's frantic ups and downs. That's a path to heartache. No, real wealth is built through informed, disciplined decision-making, day in and day out. It's about focusing on the fundamentals, the real value of what you are buying. It's about thinking like a business owner, not like a gambler in a casino. This approach might not always be the most exciting or the fastest, but it is the most reliable, the most sustainable, and the most intelligent way. It's the path that lets you build wealth steadily, securely over your lifetime. So as we conclude our journey through The Intelligent Investor, here's my final word to you. You now have the knowledge, the timeless wisdom of Benjamin Graham at your fingertips. Internalize these principles, make them a part of your financial DNA. Commit to discipline, cultivate patience, insist on value, know yourself. By doing so, you can navigate the often turbulent waters of the investment world. You can achieve your financial goals, whatever they may be. You can secure your future, and just as importantly, you can find lasting peace of mind. This, my friends, is the power of intelligent investing. Go forth and build your financial freedom, the intelligent